Hello YouTube, today I'm going to discuss my top 5 favorite stocks for the moment. Let's not waste any more time. First one is going to be Microsoft. Microsoft is of course one of the biggest companies and stocks in the world, currently with a market cap over $2 trillion. Enterprise value almost the same. The trailing PE ratio right now is 28 and the 4 PE ratio is 23. That's one of the lowest it's been in a long time. And if we look at the valuation of Microsoft, then we see year to date, of course, decline. For a PE ratio of almost 34, a little over 34, to right now under 26, 25 on something. Again, this is one of the lowest it's been in a long time. The last time was the bottom of the bear market in 2022. Then it was below 22 PE ratio. But still, 26 is still a reasonably fair price for Microsoft, one of the best and biggest companies in the world. The reason I'm such a big fan of Microsoft is, of course, the fantastic business model. Microsoft has a subscription business model where it receives income every month. That's because it works with a lot of licenses for its products. Um, I don't think the company is going to double in a few months or 1 year, but I don't also think it's not going anywhere. And it's still going to be around in 2 years, 5 years, 10 years from now. So I think you cannot really go wrong with Microsoft, even though it's not going to be the biggest compounder or the biggest growth stock anymore. It's going to grow, I think, at a slower pace. It's still one of the best stocks and safe stocks to keep in your portfolio. Okay, the second one is going to be Alphabet or Google. Google is one of my personal favorite stocks. Google has been relatively cheap or undervalued for quite a while right now. It currently has a market cap over $1.77 trillion dollars, and the trailing PE is extremely cheap, extremely undervalued, only 18, and the 4 PE is even lower at 16. And if we look at the last time that happened, here we see year to date, $206 until in the 140s, and the 4 PE ratio of almost 24 until like 16. Now, if we look at the last few years, then we see it's at the lowest it's been in the last 3 years at least. I'll say also last 5 years. Now, one of the reasons Google stock is down is also because of the court case. So the US wants to divide the company Google because they think the company is going too big, growing too big, and it has too much power. So one of the reasons the stock has been going down for a couple of months because people are already pricing in, hey, what's going to happen to Google? Maybe it will lose one of its products, and then the company will go weaker, of course. Um, but I think most of that's already priced in. I think Google's still relatively cheap compared to its peers and compared to a lot of other companies in S&P 500. Still has amazing products like Google Search, Gemini, YouTube, Google Cloud still growing. And Google Cloud is, as we speak, one of the biggest cloud players in the world. I think it's the second or third best one after Microsoft and Amazon. So the same goes for Google as for Microsoft. I don't think Google is going anywhere. It's growing strong. I think if Google plays its cards right, it can at least grow 50% from here, maybe more, because on valuation is so low. It might even double if we go to PE ratios like above 30%. I mean, over 30, above 30. Google's like Microsoft stock that can fit every portfolio, just contains a little bit more risks. It's still a very, very good company. The third one is going to be Amazon. So a few days or weeks before ago, Amazon stock was trading above $200 right now. 170 lowest was somewhere in its 160s. Market cap almost $2 trillion. Dollars. Trading PE is 30 and the 4 PE is 25, just under 26. A little higher than its competitors, but then again, Amazon was never really focusing on um, profitability like the other ones, but it's slowly catching up. If you look at Amazon valuation, Last year, of course, we see it's been going down from over 45 for PE ratio under 27. Uh, this is this is the lowest it's been in the last couple of years. But then again, that's because Amazon is focusing on profitability more and more. That's why the PE ratio continues to go down. And I think it will continue to go down even further the next couple of years. Um, but then again, it's looking good. Amazon is a very, very strong company, also a very strong cloud player. Also, Amazon is also very diversified, so not only focusing on retail, because retail can be very like cyclical. And if we expect a recession, then Amazon may go down more. But right now, Amazon is looking good, and the fact that it's also like having a lot of other segments like cloud is a good sign to me. So I think Amazon is like the other two companies, a very interesting one right now, and one of my favorites. It's definitely on my wish list. I bought some Amazon stock before when it was in the 180s. I'm gonna continue to do so when it if it goes down back again to the low 160s or like around $160. The fourth one is Meta platforms. So Meta platforms has Facebook, has Instagram, has WhatsApp. Meta has like a huge amount of daily active users and monthly active users. I think like the last time I checked, half of the population was a monthly active user for Meta platforms because almost anyone is using like Instagram, WhatsApp, stuff like that these days. Market cap a little lower than the other ones, $1.29 trillion. PE right now 21 and the 4 PE ratio is 20. I think that's relatively undervalued for Meta platforms. It's a really big company, has so many people are using the platform, and I don't think this company is going anywhere with so many people having the products. Um, if we look at the valuation, then we can see it was trading for over 26 for P/E ratio, and it's currently down to under 20. If we look at the last 3 years, it's not at the lowest point it's been. That's because Meta crashed really hard a few years ago, because Mark Zuckerberg, the CEO, was only focusing on profitability. No, not profitability. I mean the metaverse, and people didn't like that. Investors wanted them to focus on profitability, so they cut costs, they fire some people, and that's why they went up again. From the lowest point was $88 to the highest around more than $700. So more than times seven. So right now it's down. I think it's a really nice opportunity to pick up some Meta platforms for relatively low valuation. Meta platforms is one of the Magnificent Seven, like strong company, just like Google, just like Microsoft, just like Amazon, a very very strong company. And I don't think this company will go anywhere anytime soon. So very strong company and very strong stock. The last one is going to be Hims and Hers. Hims and Hers is really volatile. The lowest point it's been was around $5 a few years ago, 2022. It went up all the way to more than $72 this year or end of last year. And then it went down to all the way to $24. Right now, there's a market cap of $5.8 billion. Highest it's been is around 10. And the PE ratio is a little high, of course, in its 40s. But that's because Hims and Hers, of course, just profitable for just a few quarters. So it's not only focusing on the PE ratio. So sometimes looking at the PE ratio is not really a fair metric to use. It's not really representative of what the company is doing right now. You see the price to sales is a lot lower, 4.19. And if we look at the valuation, last year we see, of course, price to sales of 4 went down all the way to over 7. That was when the price was around $70. Highest price was around 72, and now it's down all the way to below 2.5 again. And I think Hims and Hers is a very strong company, and it's always a very good buy when the stock is trading under the PE, the PS ratio under 3. right now, even below $2.5. Of course, this is never financial advice. I'm not a financial advisor. Just a dude um, with screen recording software, just talking what I find interesting. But these are my five favorite stocks for right now. I currently own most of them except Meta. That's because I don't want too many tech stocks in my portfolio, so I have to manage it carefully. But if Meta goes down even more, then I might buy it too. I own it in the past. These are five interesting stocks right now. I'm not saying there aren't any other interesting stocks around. I might make another video, but right now these are my top five stocks. Um, I also forgot to say is that Hims and Hers went down. That was also because the weight loss stuff. Hims and Hers was selling weight loss drugs like Ozempic, like substitute for Ozempic. But then they couldn't sell it anymore, and the reason was because the shortage was over, and they could only sell the substitution as long as there was a shortage, like FDA rules. So stock reacted extremely volatile to that news when they couldn't sell any weight loss drugs anymore. Then again, the last quarter, the CEO Andrew Dudum um, said that they would make their own weight loss drug, which is scheduled to launch in Q2, 3, or 4 this year. So I think Hims and Hers will do all right, and they will make their own weight loss product. It's not the biggest part of their revenue, but it is the reason why the stock has been going down. One of the reasons the stock has been going down such extremely. Anyway, I still think it's a really great company, and these are all very good companies. Let me know in the comments what you think, which one of them is the best, and if you currently own one of them, and if so, why. Let me also know which companies I need to research next time in the comments. Don't forget to like, comment, and subscribe, and I catch you in the next one. Peace.